Well, Goldman Sachs just told us that its profit grew 18% in a single quarter. That's true. And it's also the wrong number to be looking at because underneath it, the actual engine of the business grew 32%. Same quarter, same company, a 14-point gap between the number in the headline and the number that describe the business. Today, we find the 14 points and what they tell you about how good this quarter really was. I'm Vikas, your host. This is what changed from Wing, VYNG. We don't chase headlines, we explain what changed. So, basically, three lines before we dig in, particularly what was the headline and the reality check and the verdict. The Goldman's net earnings rose 18% from the first quarter to the second. And reality is, this headline is true, but the pre-tax earnings, the business before the taxman takes a cut, rose 32%. The bottom line number was held down by a tax rate that nearly doubled this quarter. So our verdict is this was a stronger operating quarter than the 18% suggests. For once, the headline understates the story instead of overselling it. Let's start with that gap because it's the key to the whole quarter. When a company reports earning, there are really two numbers worth separating. There is what the business made, that's pre-tax earnings, and there's what left after taxes, that's net earnings. The bottom line, the one that goes in the headline. So most quarters, those two numbers move together. If the business grows 20%, the after-tax number grows roughly 20% too, because tax rates stays above the same. This quarter, they came apart. The business pre-tax grew 32%. The bottom line grew 18. So where did the other 14 points go? Yes, taxes. And here is the part worth understanding because it's the anchor for everything today. Think of it like a paycheck. Just think of it like a paycheck. Imagine 1 month your employer gives you a one-time bonus, and on top of that, that bonus happens to be taxed lightly. Your take-home pay that month looks great. Now the next month, no bonus, and your tax goes back to normal. Your take-home drops, even if your actual salary, the thing you earn every month, went up. That's exactly what happened to Goldman. In the first quarter, the company got an unusual large one-time tax benefit, around $895 million dollars. From settling stock awards it gives employees. That was the main award which was benefiting it from the tax. So that pushed its quarter tax rate down to just 13%, artificially low, a one-time thing. This quarter, that benefit didn't repeat, so the tax rate snapped back up to about 23%, a normal rate for a big bank. The high tax bill quietly took roughly $800 million off the bottom line. So when you read profit up 18%, you are reading a number that's carrying the weight of a tax rate returning to normal. Strip that out, look at what the business actually earned before tax, and the growth was 32%. That's the engine's real speed. Now, what drove that 32%? One word, trading. Wow. Specifically stocks. Amazing, huh? Goldman's equity business, buying and selling stocks and helping big investors do the same, brought in $7.4 billion this quarter. That is the highest it has ever been, up 39% from the first quarter and up 72% from a year ago. Now we can think that if the big banks are making this much of profit, we no need to be cautious about markets and where markets are going, where inflations are going. So from these numbers, it clearly tells the banks are making big profits. They are keep on investing, keep on trading in the stocks. So when markets are busy and volatile, this is the business that lights up. And this quarter, it lit all the way up. But it wasn't just trading, and that's what makes this quarter interesting rather than lucky. Every client facing part of Goldman grew by double digits. Let's talk about investment banking, the business of advising on deals and helping companies raise money, and grew 20%, and it's up 55% from a year ago. The bond and commodity desk also grew 14. The asset and wealth management arm grew 13. There was only one business that shrank, and we will get to why that one shrinking is actually good news. Three numbers then tell this real story of this quarter. 18%, the headline, held down by tax. 32%, the real engine, once you strip the tax noise out. And 7.4 billion, the record trading quarter that powered it. The first is the number you will see everywhere. The third is why the second happened. So here is why this more than one good quarter and where the honest question lives. Well, start with the good because there's a lot of it. Goldman's return on equity, the cleanest measure of how hard the whole firm is working for its shareholders, hit 23.5% this quarter. For a bank, anything above roughly 15 is very strong. 23 is very, very strong. And it's been climbing 3 quarters in a row, which is a great sign. The company also got more efficient. It's keeping more of every dollar of revenue as profit than it did a year ago. And the board did something that matters more than any single number. It raised the dividend by 11%. Remember the paycheck analogy? Dividend raise is management's way of saying this is not a one time bonus. We expect this level of earnings to last. You don't raise the amount you commit to paying shareholders every quarter unless you are confident the money will keep coming. That's a durability signal, and it's the most reassuring thing in the report, where it gives the confidence to shareholders. There is also a quieter milestone like the assets Goldman manages on behalf of clients, supervised assets. They have crossed $4 trillion for the first time ever. And why does that matter? Because managing money for a fee is steady income. It doesn't swing with the market the way trading does. So every dollar Goldman adds there makes the whole company a little less dependent on the wild quarters and a little more dependent on the predictable ones. The market pays a higher price for that kind of steady earnings. Now, what is the question? And this is the one thing to hold lightly, that record trading quarter. This is the cautious thing. Records are by definition not the normal. Trading revenue rises and falls with how volatile and busy markets are and were. And this quarter, markets were very busy. That won't be true every quarter. So we have to keep this thing in our mind. So the honest question for an investor is not, was this a good quarter? Clearly, it was. It's how much of this record can you count on repeating? And the honest answer is not all of it, which is exactly why the quieter wins matter more than the loud one. The deal advisory backlog, the pipeline of future banking fees actually grew this quarter. The $4 trillion supervised assets number is steady, fee based money. So, those are the things that can carry results when trading eventually cools off. The record grabs the headline, obviously. The backlog and the fee based are what you actually build a thesis on. So, here's where we land. Last quarter, our what changed read on Goldman implied a conviction score of 7 out of 10. Today, after looking at this quarter two earnings, that moved up to 7.8 out of 10. The quarter was genuinely strong. The operating acceleration is really one you read it pre-tax, and the breadth of across every business plus that dividend raise earns the upgrade. What keeps it from scoring higher is the same thing that made it shine. The biggest single drive was a record trading quarter, and records don't repeat on schedule. Now, that number is not a buy recommendation, not a sell recommendation, just our assessments of how much confidence today's evidence deserves. So, for next quarter, three things uh, we will answer. We need to focus. Number one is, does the banking backlog convert? The pipeline grew. The the tell is whether it turns into completed deals fees. That's the durable engine. Number two, how far does trading come back to earth? Record is not a floor. When volatility fades, watch how much of that 7.4 billion holds. And number three, where does the tax rate settle? This quarter's swing was noise on both hands, the normal. Full year rate is the bridge between the strong engine and the reported profit. The real story of Goldman quarter isn't the profit grew 18%. That's the business grew 32. The tax line just hide it, and that the strength was broad, not lucky. Even if its loudest piece was a record that won't repeat every time. If you would like to explore every chart, source, and calculation behind today's analysis, you will find the complete research report at vyng.io, vyng.io. Everything is sourced directly from Goldman's filings because trust isn't built by confidence, it is built by transparency. I am Vikas. This is what changed from Wing. We don't report everything, we report what changed. Clarity, not clutter.